Let's kick off in China this morning, where we have our regular commenter, Victor Yang, senior editor at JLC Network Technology. Victor, welcome back. We haven't had you on in a while, so nice to hear your perspective on the markets, which have clearly moved a lot since we last had you on. We're now up again this morning, the fifth day in a row. This market is on a tear very quickly to hit $75 on Brent. We have now the infamous $100 headline starting to appear as a potential target. But Victor, my question to you is, we're not hearing too many complaints from the emerging economies like India or China in terms of the big consuming countries.
Well, first of all, I'm quite doubtful about the $100, price in the future. Yeah, say after all, demand is still quite uncertain, to say the least, we'll say. And so this is there's kind of speculation in the market too. Just like last month when I was joining the daily webinar, you mentioned the commodity prices too, and what the government was doing to keep the prices under control. Say they are taking some kind of measures outside the market to say like cracking down on behaviors that corner the markets or speculation, trying to keep the commodity prices, at a reasonable level at least. Say, for instance, now the cost for manufacturers in China had actually gone up quite significantly. And say some factories will actually stop taking new orders because, one is the higher cost, and the other is, they have got plenty of orders from overseas too. Saying in the past, when we saw, the US, the United States, printing a lot of, cash as well, other countries would follow, say, including China, and usually there was not an inflation following, but this time it seems quite different. We
have seen in recent months a somewhat of a dip in Chinese demand, or at least Chinese buying, and yet the oil prices continue to rise. Is China going to get back to buying more, and should we expect that to give more support to the oil price?
Yes, and first of all, I remember you asking a question about the decline in China's May imports. Last week, was it because of the restructuring or because of consumption cycle?
Yes.
And I remember about 15% chose the second one, restructuring, and most go for the first one, the consumption cycle, something like that.
Yes.
And I would say, for this time, yes, for the moment, mostly because of the consumption cycle, but the restructuring is also beginning to make some impact, but not significantly yet. In the future, the impact from the restructuring would be more significant, as now China is now, stepping faster with the restructuring or reform of the oil market. Say, last month, a state-owned company was reported to the country because of its, violations of the regulation of the oil market. And then the country require all the state-owned oil companies to report their use of imported crude in the past years. Say, one company, a very large one, and it was reported that the companies sold imported crude to independent refiners against regulations. So the government required them to report on their use of imported crude. And the inspection had been going on since May, after those, well, after the inspection at independent refiners, well, so in the future, demand from independent refiners could be impacted because, well, independent refiners need quotas to import crude, and their quotas are likely to be slashed later this year because of their violation of the government's regulation on the use of imported crude. So the government is actually becoming, well, increasingly intolerant with this kind of violation.
Oh,
And
should we
so,
expect that the Chinese will dig more into their inventories and use more inventories rather than buying crude at these prices?
well, I would expect to dig more into the crude inventory than buying more at the moment. But on the other hand, the refinery maintenance is coming to an end now. So actually, refinery rates have rebounded quite significantly. So this one would help to drive up demand to some degree. But on the other hand, faster restructuring and high stocks would slow down the growth to some degree. So basically, that's
This is the survey, the question that you were referring to, that the response to Chinese oil imports at a 5-month low, it was just temporary, cyclical, rather than a weakness in demand. But you're indicating that demand or imports could remain low.
Well, it could rebound modestly from this level, but first of all, we need to remember that this level was just kind of average before the pandemic. So
Right.
it's not, it doesn't mean it's a low level. It's just relatively low compared to, well, those imports in the past few months, well, past year or so. So this is kind of, well, it's
back to the trend.
level.
Back to the pre-COVID trend. Let's bring in Sarah Akbar, Chairperson and CEO of OilServe Kuwait and Non-Executive Director of Petrofac. Good morning, Sarah. It would appear that based on OPEC's continued discipline in controlling supply, that they're happy and obviously targeting a higher oil price than maybe most people had expected. That 65 was sort of the sweet spot. Now we're knocking on the door of 75. Should we expect this is sort of the target area for OPEC plus?
Well, good morning, Sean. I don't think they declared what is their target price. So they never said that, our target price is this or that. Now, if you can sell more barrels at a higher price, then why not if the market is there? But we have learned the lesson. I think OPEC and non-OPEC, everyone has learned the lessons from the past that if you exaggerate these prices and you continue on this upward trend, then on the long run you lose. We know this very well from all the cycles that we have been through in the past. So because other fuels kick in at these prices at 75, definitely you have the shale oil probably come back. Already there is a lot of activity going into the shale. A lot of capital now is looking back into the shale, and the other renewables become far more competitive than
What
oil.
about in this region, Sarah, that we would see more investment into, obviously you're in the oil services business in Kuwait. Is there indications that the regional industry is going to be investing more and developing more capacity locally, given these prices?
Capacity, I think, in this region, people never change their plans based on this cycle because, yes, there was a little bit delay in sanctioning of some projects, but it was purely delay. It was not cancellation. So the plans, we go through cycles. We don't move with cycles. It has been the norm in the region. I think, we heard the Saudi oil minister saying that they are on you know, they want to go to 13 million, and probably they have already plans in place to go to 13 million. The UAE is posed for 5 million, and they are on that route. So in this region, I think we never go slow because of a cycle. We just go through them and we continue the plans as if things are on the upward trend all the time. It's been the norm in this part of the world.
It has been a period of 2020 at least, Sarah, that the regional NOCs did cut back quite dramatically on the cost architecture of the supply chain. I think ADNOC, if I remember, said 30% cut, similar in Aramco. I mean, they've really put a tight squeeze on your peer group. Has that eased a bit, or is it still resembling last year's tightening?
No, it is still there, the tightening, and it was completely merited because over the last few years, everything was inflated. So it is not, it's more efficient processes that are in place. The cost, it's more manageable now. So this is not like, it was like a true correction in the infrastructure of the industry in these countries. So it was a moment for reflection and change. And I think this change is here to stay. It is not to go back to the same ways of doing business where we have the G&A so high and, you know, the gold plating of the industry. So I think there is more of this institutional, efficient process that put in place, and this pandemic, the lower oil prices was the engine for this change, and this change is here to stay. But what I'm saying is the major projects, the big projects, the developments, they were delayed, yes, but definitely they will happen this time now. That's purely delays.
Victor, just coming back to the outlook for the Chinese sector, coming out of the refinery maintenance season now, how robust is the throughput looking like? Will the refineries in China ramp up to higher levels of production?
Yes, well, and we are expecting official data on May throughput this afternoon. And then we can see how May throughput did well. But actually in May, throughput was not high yet because of maintenance. Well, and now after maintenance, well, we expect to be back to kind of normal levels. Well, and in the future, well, as another new large refinery is coming online, say in about August, a private one, 32 and 320 million, 320,000 barrels per day, a private one. And so as more large one come online, and the kind of integration of refinery, the chemical and oil production industry, well, so we will see more and more large refineries in the future when small ones are phased out. And this is a kind of trend. But what now the market is focused on is also the country's oil product exports. Well, and you know, in China, when refiners export refined oil products, well, they need the quotas. Well, quotas, and so a lot of traders, well, are expecting China to release, well, this year's second batch of quotas for exports. Well, and now the government is heard to slash the second batch of quotas. So oil product demand in Asia and even say in the world could kind of change a little bit in the future. As well, we expected China before. I mean, we expected China to kind of boost its exports, well, to some degree. But now the country seems to be discouraging large exports, well, and refiners are losing interest in exports either because of relatively strong prices in the domestic market when international markets are kind of weak. and demand, international demand is not so strong. So there's a lot of focus and interest on this kind of policy change now. So in the future, when the country focus more on domestic demand and exports less oil products, so the supply pattern could change. I mean, particularly in Asia, as China's gasoline and diesel exports were mostly to Asia, and particularly gasoline exports. So this is kind of tropical event now for a lot of foreign traders who care a lot about the Chinese market, and this is also a trend. And on the whole, demand in the future, I mean, the throughput would grow. I mean, but perhaps not as significantly as well as the past few months. But it will surely rebound to some degree after maintenance.
Sarah, I wanted to ask you about the situation in Kuwait. As of this week, we just had the GDP numbers for 2020, and Kuwait's gross domestic product economy contracted by 9.9% in 2020. I'm wondering, what is the situation now? Kuwait obviously benefiting from a higher oil price. How challenged is the fiscal position in Kuwait?
Yeah, it is still challenging because I think the break-even price that we need to balance the budget is like $78. So if we get to 78, then I think we can cover all the requirements of the budget. But
is that at the reduced production level with the cutbacks?
Yes, it's about, I think the production level is around 2.2 million or something like that. But the point here is that we have a political standstill between government and parliament. So the government is really not able to pass few legislation that are essential for financial management of the cash flows of the country. So as you know, Kuwait is, as a very wealthy country, we have, we have the oil reserves, we have the foreign reserves that we have. The issue here is only the financial cash management, and for that we do need to completely restructure things and change the way we do business here. But because of the standstill, we are still in that hole. I think this situation will definitely change because there is no way it will continue.
I mean, we are seeing across the region, Sarah, that both on the national energy level in the UAE and even in Oman now making fairly dramatic reforms on labor. But Kuwait doesn't seem to be taking the same kind of strides that others are doing. Would that be a fair assessment?
It's a very fair assessment. And the main reason behind that is the system, that the political system we have here works on consensus. And as you imagine, most of this reform is not popular. People do not want you to impose taxes. People don't want you to change things. They are really change averse. But I think at the end of the day, these things have to happen in Kuwait, just like the rest of the region. And it has to be done with this consensus as well. So I believe the government does have a plan. Yes, last week there was heavy discussions in the cabinet about the tax system here, the VAT and all the other taxes. And I think that legislation will go to the parliament very soon. Yes, this is not popular, but I don't think there is any other way around it. So,
I mean, Oman recently has reduced their commitment to graduates, where they previously had a certain salary level for graduates. They've now essentially dropped them down to the same level as non-graduates, and ultimately to discourage nationals from seeking employment in the public sector. So it seems across the region some big changes. Let's go to the survey question, and then I'm going to try to get Rustin Edwards into, because I'm really keen to get his insights on the record price of shipping which we hit this week. But firstly, what will be the Brent high for the second half of 2021? I'm curious to get the room's view on what will be the high for Brent. Not will it average, but what will be the high point that it'll touch in the second half of this year? And today, of course, we're just a stone's throw from $75 a barrel. So we're racing through the 70s at the moment. But what will be the high in the second half of the year? Closer to $80 a barrel, closer to $90 a barrel, closer to $100 a barrel. Dare I put that on the screen for the first time this year, this whole cycle, but it is somehow in sight. And I welcome your views of what could be the high for Brent in the second half of the year. Let's just ask Rustin Edwards of Euronav to make a quick comment on what we saw this week in terms of the price of shipping skyrocketing, the transporting a 40-foot steel container of cargo by sea from Shanghai to Rotterdam hit a record $10,000, 522, which is 547% higher than the 5-year average. It's a 547% higher than the 5-year average. I mean, it is quite extraordinary. Rustin, your thoughts on this particular data point being reached?
Hey, good morning, everybody, and thanks for the commentary on container. It's the story that's been hitting international freight markets pretty much all year. We've had multiple supply chain disruptions, from COVID to the Suez Canal blockage to the short-lived recoveries that are now starting to gather hold in the United States as well. And you're starting to see these delays in a lot of different ports. I mean, the current issue right now is that in Gaozhong and Shenzhen, which are two of the largest export facilities in China, they're experiencing 16, 17-day delays in getting ships in and out of the port, which are then causing shippers who want to move boxes to reroute boxes to other ports, which then incur even more cost. And it just starts adding up to the inflationary pressure that we're seeing across the board. Couple that with the higher price of fuel, because if, as fuel prices move it along the same route that crude oil prices have been moving, you've got, VLSFO bunker fuel price above $525 a ton. You've got high sulfur fuel above $400 a ton, even higher in some other markets. That even adds more price pressure to the market. When you think that that's been another $100 to $150 a ton in fuel costs that has happened over the last 6 months. So it all just adds more upward price pressure to the price of freight. Now, we're seeing this mainly in the container space. You're also seeing it in the dry bulk space, so the raw materials going in to make finished goods. Those prices are going up mainly because, again, there's a lot of surge capacity to bring in the iron ore, the grains, whatever that go into the mass production of goods. And with that, you enhance even more further delays in delivery of goods. And so it's just this inflationary story coming to root. I mean, that $10,000 box is eventually going to impact the price of your Nikes.
Yeah, you wouldn't want to be moving house this summer, and a lot of people will be, in terms of at least expat universe, packing up and moving around. That's going to cost a lot.
And the interesting thing, Sean, is that Home Depot, which is one of the larger box stores in the United States, akin to Walmart, but they're more into the home improvement sector, they've actually chartered in their own ship, which is the first time they've done anything like that. I forget the size of the container ship, but a fairly large container ship, to secure their own supply chain because of all these delays that are happening downwind or downstream from their retail side. They don't have the goods in store to sell. So when you start seeing retailers chartering a ship, that just tells you this inflation period is going to continue on all the way through 2022.
What about tanker rates? We're hearing about Iran storing a lot of oil on the water, obviously in their own fleet.
Tanker rates are still relatively low. I mean, if you look at, the dichotomy of tanker rates versus the forward recovery story that all the analysts keep throwing out there. If you looked at tanker rates right now, you would think there is no oil recovery. Cal 2022 tanker rates are for TD3 at 9.5, 9.6 a ton, which equates to about a $16,000 a day time charter rate, which if we had a recovery that's being projected by everybody, tanker rates should be closer to $25,000 a day on a forward curve. So it is something where the freight markets are not pricing in a recovery just yet. It might be more of a, let's wait until we see the whites of their eyes, i.e. how much oil does OPEC actually put back into the market? Does Iran come out of sanctions that would generate a higher TD3, TD20, TD8 type tank rates than what we're currently seeing?
Thanks, Rustin, for that update from shipping. Really appreciate that. Victor, obviously this is a big deal for China. Very, very expensive to move goods out of China towards the Western markets. What impact is that likely to have on reaching China's massive economic GDP numbers that are targeted or expected this year? There was talk of close to 10%. What do you think the impact that will have on China's growth this year?
Well, first of all, this kind of shipping rates could actually hit our pockets first of all, I mean. And it would actually be mostly burdened by consumers too. And as for factories and manufacturers, well, they produce only when they can afford the cost. And so basically, in the end, is the consumers who pay the higher cost. And as for the GDP impacts, well, it wouldn't be so significant. Well, so when the extra costs were burdened by the consumers, well, particularly, say, just like the inflation in the United States, well, when the, say, about 20% higher, 25% higher prices of goods were still bought by the United States, and even exports to the United States surged by about 50%, say, last month, well. So this is kind of issue most relevant to kind of consumers too. And as for the impact on China's GDP growth, there might be less significant as well.
Let's get the survey result and give Sarah the last word this morning. Not a lot of the people in this room are sort of buying into this very bullish feel in the market, although $80 still is a very big number. But I obviously didn't give people the option to put $70. So, but we're the highest. We're going to probably touch 75. It would look like maybe even today. But 65% of the room saying $80, and then of course you can see 27 on 90, and a very few buying into the $100. Sarah, OPEC have to meet soon again to decide, and they cannot postpone because July 1st is the last meeting before August, which is when this current supply increase expires. What would you expect from OPEC given the demand numbers and the dollar oil price? Do you think they will continue to play a very tight game, or will they open the taps a bit, do you think?
I think by now they will start to open the taps. As you know, there is about 5 to 6 million barrels of crude locked up in various countries. So some of that will have to come back. I believe, my own thinking that they will have to open up the tap. Probably they will add like 1 million barrel additional to the market to cool off the market. Because like I said, we've been through the cycles where we see higher oil prices are as harmful as the very low oil prices. So they have to keep the range. And for that, because of the demand, responding very faster than they thought, I think faster than anybody thought, the demand is coming back. So they have to balance that by adding some production to the market. So I believe they will open up the taps in 1st of July.
And would you think we saw them open the taps recently, obviously in this 3-month cycle, May to July, the total over the 3 months is adding up to 2 million barrels, which is quite small when you remove the Saudi piece of that, which is half of it. Would you expect them to be a little bolder on this occasion?
I think so, because I don't think anyone expected this level of price. And, you know, with the forecasts that you can see, you know, people expect $80 or $90. They will open the tap a little bit more, especially I think Russia will insist. And
I know in Kuwait, it's quite costly to keep idle capacity for so long, right? I mean, if you have a market and you're keeping your production closed in, that's quite a challenge in countries like Kuwait.
Yeah, where you do need the capital, you really need the money. So, you know, we have like 800,000 barrels of closed capacity here in Kuwait. I think we are very keen to put some of that back into the market.
Yeah, I would think so. Well, let's wrap it up there. Just to close with, keep an eye out today. Prince Abdulaziz bin Salman is speaking to a conference in Wall Street. It'll be quite interesting to see what he has to say to particularly the investor community. And we have the Fed meeting as well. So it's a big day for issues that could impact the direction of this oil market. I suspect in both cases, they're probably going to be supportive to the upward move. We have an interview that will be published now with Richard Radoglia, who's a technical analysis expert in the oil markets, and he's showing some graphs that indicate that at least from the technical side, this market is clearly on an upward trend and there's still more space to go. So it's still a buy and hold. So that's if you have 20 minutes, half an hour, listen to that interview. But thank you, Sarah. Thank you, Victor. And unfortunately, this morning, Dr. Sarah Vakshuri, who was going to join us from Washington, D.C., had to call off late and wasn't able to join us, but we'll get Dr. Sarah back soon again. But thank you, everybody. Have a great day, and we'll catch up with you later in the week. All the best. Thank you, Sarah.
Thank you.
Thank you, Victor.